The global insurance sector has quietly transformed over the past few years as private capital firms, like Apollo Global Management, KKR and Company, and Brookfield, moved aggressively into life insurance and annuity markets. This once conservative industry has become a new frontier for private investment, fueled by the search for stable, long-term capital and higher returns. But what began as a powerful growth story now appears to be reaching a fragile peak, marked by slowing returns, intense competition, and growing regulatory concern. The rise of private capital in insurance. After a decade of near-zero interest rates, traditional insurers struggled to generate profits from safe government or corporate bonds. Private capital firms saw an opportunity. They began acquiring or partnering with life insurers to channel policyholder premiums into alternative assets such as private credit, structured loans, and real estate-backed securities. In the U.S., fixed annuities, contracts that guarantee income to retirees, became the cornerstone of this expansion. By 2024, fixed annuity sales surged above $300 billion, accounting for more than 70% of total annuity sales. Private equity-owned insurers offered higher yields than traditional companies by investing premiums in assets with better returns than standard bonds. This created a self-reinforcing flywheel. Private firms issued more policies, gained steady long-term capital, invested that money into high-yield assets, and used the profits to fuel further growth. For several years, it seemed unstoppable. Why the model worked? For investors and retirees, these products looked like a win-win. Customers received higher guaranteed returns than bank deposits, while private firms secured permanent capital to manage. The insurance business offered them something rare in the world of private equity, a stable, long-term funding base that didn't depend on short fundraising cycles. Private capital managers brought sophisticated investment techniques, allowing them to unlock value from niche credit markets. In a world still adjusting to inflation and uneven growth, the blend of steady insurance cash flows and higher yield investments appeared ideal. Signs of fragility emerge, yet beneath the success story, cracks have started to show. The extra yield that once made the strategy so attractive has shrunk as more players enter the market. Competition for high-quality private loans and securitized assets has driven up prices and squeezed margins. At the same time, insurers face the classic problem of scale. With yields tightening, they must sell ever larger volumes of annuities to maintain profits. This dependence on continuous growth creates vulnerability. If economic conditions shift or investor demand weakens, the business model could lose momentum. Another risk lies in asset quality. Many private credit markets have yet to face a full economic downturn. If defaults rise or asset values fall, insurers heavily exposed to illiquid or complex investments could see their balance sheets strained. Interest rate volatility adds another layer of risk. A sharp fall in rates could reduce the appeal of fixed annuities, while a rise could erode the market value of existing investments. The mismatch between long-term liabilities and shorter-term assets remains a structural challenge. Regulatory and global headwinds. Authorities are also watching the trend with growing unease. The infusion of private capital into insurance introduces potential opacity, complex ownership structures and unconventional investment portfolios that regulators may find hard to monitor. In Europe, skepticism is already building as U.S. private firms seek to replicate their American success across new markets. Some traditional insurers and consumer advocates warn that policyholders may not fully understand the risks of products backed by non-traditional investment strategies. Calls for stronger disclosure and capital adequacy rules are rising, particularly as firms chase yield in riskier corners of the credit market. What comes next? The future of this boom depends on how adaptable these firms are. Many are pivoting toward institutional deals, selling funding agreements to pension funds or reinsurance contracts, where pricing is less sensitive to consumer sentiment. Others are exploring new asset classes or international markets to sustain returns. However, growth at the same pace is unlikely to continue. As the easy profits from private credit fade, the industry will face a critical test: whether the insurance private capital model can deliver durable, transparent value without the tailwind of an exceptional yield gap. Conclusion: the private capital insurance revolution has reshaped how life and annuity products are funded and invested. It has brought innovation, efficiency, and higher returns, but also new risks. The sector stands at a delicate point where enthusiasm meets realism. The boom may not collapse outright, but its peak is likely behind us. The next phase will reveal whether this fusion of Wall Street's ambition and Main Street's savings can evolve into a sustainable model, or whether it will become another cycle of overreach and correction in modern finance.